NIO's stock has risen fivefold just since early April, and shareholders have higher hopes than ever the electrical vehicle company can do in China what Tesla has done in the US market. But what is NIO? Why has the stock been booming? And most importantly, would I buy in? Stay tuned for today's video to find out all. Welcome back to the channel, fellow investors. It's your boy, the Capitalist Investor here, bringing you another Would I Buy video. If you're new to the channel, thanks for clicking on the thumbnail and finding yourself here with me in my office watching me talk about NIO. But most importantly, let me tell you some more about this channel. The aim of this channel is to bring you stock market information, money tips and wealth creation. If this is something that you like the sound of, make sure you hit that subscribe button for more content. If you're feeling extra generous, hit that like button to help more people find this video and this channel. Thanks in advance for your support. Okay, so what is NIO? Well, NIO is a Chinese vehicle manufacturer headquartered in Shanghai, specialising in designing and developing electrical autonomous vehicles. NIO was founded in November 2014 by William Li, and in 2018 the company filed for IPO on the New York Stock Exchange. NIO is one of several companies in the electrical vehicle space, and there's seen a surge of investor interest in the wake of the huge run-up in Tesla share price in the recent months. But NIO has a few things going for it that many others don't. One, it's shipping vehicles. Two, sales are growing, and it has money in the bank. NIO shares had recently got a boost when the company reported that its second quarter sales had nearly trebled from a year ago, exceeding even its own expectations. Not only did that sales report make clear that NIO and its customer base have largely recovered from coronavirus outbreak, it showed that the company is now reaping the benefits of the sales network it spent so much money to expand in 2019. Even the CFO, Stephen Fang, hinted last week that the second quarter sales results had set the company up for a strong financial result. We'll find out when NIO reports its second quarter earnings, likely sometime mid-August. However, with the share price rising so quickly, NIO needs to show investors some signs that the fundamental business prospects can keep up. In particular, the following three things would show NIO investors that the company has the endurance to be a long-term player in the EV industry. It needs to see delivery numbers rise, and rise markedly. The event that spurred the latest move higher in NIO shares was its release of those second quarter vehicle delivery volumes. Investors were pleased to see that the uptick in deliveries, especially given the coronavirus pandemic had had an impact on the economy. June deliveries mounted to more than 3,700 vehicles, up from just 1,300 in June 2019. However, second quarter deliveries of more than 10,000 compared quite favourably to 3,500 a year ago. Yet this isn't the first time that NIO has sold between 3,000 and 4,000 vehicles in a month. And in late 2018, NIO surpassed the 3,000 mark in both November and December. Monthly figures in the second half of 2019 were more consistent from month to month, but still remain largely within a range of 2,000 to 3,000. Contrast that with Tesla, which saw 50% growth in vehicle deliveries in 2019, hopes to deliver 5,000 units this year. NIO has done well as a new company. But it needs to climb out of that range and start building demand for its models. In addition, NIO needs to start investing its capital well. Many startup businesses fail because they don't have the capital to build out their business successfully. That's especially true in capital-intensive industries like manufacturing. NIO doesn't have that problem, though, because it had consistent financial support from both private and public sources. On the private side, it's got Chinese internet giant Tencent Holdings, and they have repeatedly invested in NIO, boosting its stake to around 50% just last month. And the public sector joined in for an economic development fund that will help promote the company's relocation to Anhui province. Investors are breathing a sigh of relief that NIO has liquidity at a time when many companies are starved of cash. But that's not enough to justify big share price gains. NIO also has to use that money wisely with expansion plans that can demonstrate the company's ability to follow a strategic vision. And finally, the bulls will be looking for NIO to deliver some hit new vehicles. NIO's first electrical vehicle was an 8-passenger SUV, dubbed the ES8, that drew an impressive audience. Yet when the automator followed up with ES6, which as you guessed it is a 6-passenger SUV, it essentially cannibalized its own past success, as ES8 sales sank to a near standstill. Even as ES6 sales took their place, NIO has plans to go in a slightly different direction with its next model. The EC6 will be a coupe model, although NIO is calling it a coupe SUV. It will offer long-range driving capabilities of more than 380 miles and provide acceleration from 0 to 60 in 4.7 seconds. That puts it in the same class as a Tesla Model Y, and NIO definitely wants to position itself as an alternative to its American competitor. Tesla has been successful in part because it offers a wide range of different vehicles. NIO needs to prove it can make the EC6 successful, and it then needs to show a longer term strategy on how it intends to keep its customers coming back for more. Okay, let's check out some of the underlying financials. Now, interestingly, Simply Wall Street and analysts see this stock as overvalued at the current price of around $14 and would suggest a more fair value price of $11. I think this is really a reflection of the startup phase of the stock and the hype in particular around the stock. It's currently unprofitable, so no PE ratio, and the price to book ratio is actually negative, which is a little scary, guys. As you'd expect, future growth is expected to be great, as just short of 40%, although free cash flow is not expected to be positive until 2024, which is a reasonably long period of time. NIO has negative shareholder equity, which is a more serious situation than a high debt level. 11.5 billion level of debt is large for this business, but is no doubt funding the exceptional growth that is forecast. Let's imagine for a second you're invested in NIO now at $14, and then it turns out to be as big as Tesla, with a current share price of $1,508. Imagine the returns. You can all call me a millionaire now. Only joking. This is a long way off Tesla. But maybe a small holding now, just in case, would be a sensible idea. But do remember, guys, this is effectively gambling. The stock is very much in an infancy phase and has a lot to do anywhere to be as big as Tesla. Bearing in mind Tesla was at $20 in 2010, there is every chance that this could happen to NIO. Be sure to come back to this video in 10 years' time and let me know that I was right. Anyway, fellow investors, that's my take on NIO. It's a speculative stock at the moment. I think I'm going to hold a small tranche of it just in case it does blow up, but fully appreciate at this point in time it is merely a gamble. Let me know your thoughts in the comments below. Is this a stock that you want to add to your portfolio, or is it just a craze that will die out sooner rather than later? Either way, let me know. If you've stuck with me till the end of this video, guys, remember to hit the like button. I've been told every like on this video will make your portfolio go up by 1%, but that's just rumours. Anyways, I've been the Capitalist Investor. You've been YouTube, and until next time, subscribe!